What is up, everybody? Welcome back to another edition of the Zero Hedge podcast. I am here with Quoth the Raven. I've been a longtime reader, getting the stock tips, and well, it's great to have you on. Nice to have you here today, pre-July 4th.
What up? How are you?
I
Very
am.
few people I would do podcasts for, but Zero Hedge is one of them.
There you go. You got why? You got big July 4th plans?
No, just not doing podcasts are basically my plans. I stopped doing my own. I feel like I don't have anything of dire importance to say anymore. Whatever I do have to say, I kind of, shoot out on my blog, and that's about it. And so I've, kind of stopped, done like a cease and desist on the podcast. It's just, yeah, at some point it becomes fruitless. There's only so much you can comment on. You have control over nothing, and that's it.
Well, I've made a career out of repeating myself and droning on about nothing, so I will continue to make use of the space, and I'm honored to have you here today. Uh,
Thank you.
Well, to kickstart this podcast, obviously the new spending bill just got passed. I'm not a fan, just for the obvious talking points of I'd like to see government spend less money, not more money. Any quick just scoops on your takeaway from the new spending bill that just got passed?
Well, I mean, I don't think I can offer anything new that most Zero Hedge readers, podcast listeners, Austrian school thinkers don't already know, which is just that, this is the way things have gone time after time. Again, at least in my lifetime, since I've been paying attention to politics, there's been, multiple promises of balancing the budget, reducing the deficit, and it never seems to happen. I mean, I don't know who the last person to balance the budget was. Bill Clinton, maybe. I'm not even sure. But at least since I've been paying attention, it hasn't happened. Every 4 years, things just seem to get worse. We rack up debt faster. We spend more money than we have quicker. And this really is no different, sadly. I mean, there's a whole camp now that's like, okay, like we're going to kind of grow our way out of the debt problem and all these kind of end around ideas. But for me, I was very hopeful that with Trump embracing the Bitcoin community, and I know he's surrounded by some, much better economic and financial thinkers than people on the Democratic side of the aisle. I've heard the idea of like a 250-year gold-backed treasury getting floated around. So I know that they look at money and they look at finance different. And so you do kind of come into that with this glimmer of hope that at some point, somebody will try to balance the checkbook a little bit, but then politics and pork always prevail. And it does sadly feel a little bit like we're heading in the same direction we were heading. The difference being, obviously one, like whether or not we do have a chance to kind of grow ourselves out of our debt to GDP problem, which remains to be seen. And the difference also being that for whatever constellation it is, I don't think things with this bill are as bad as they would have been had Kamala Harris won the election. I think they probably would be twice as bad. Does that make it great? Does it make it the ideal spending bill that I want to see? No. Like, do I wish we could have cut significantly more? Do I still think that there are things that we could cut? And I think, we've kind of thrown our hands up in the air on the cutting spending problem. It was talked about during the campaign, and then, Doge kind of came in and for the most part, like failed to make any meaningful cuts after promises of whatever, $1 trillion or $500 billion of cuts. And a lot of serious Austrian thinkers and people that I listened to kind of knew that that wasn't going to happen, because you start really quickly brushing up against that third rail where the cuts that you make are just simply going to lose you votes and make you unelectable, which is to say nothing of just being unpopular. So I was disappointed that happened. I do think there's probably still room for more significant cuts. I was, when you look at something like USAID and the way that, taxpayer money is being spent, I mean, you and I both know that there is just gross corruption, gross malfeasance, gross fraud and abuse. Anytime you're just spraying taxpayer cash or printed cash willy-nilly. I mean, at one point I was reading they gave some idiot like Rashida Tlaib $5 billion to manage a program on subsidizing refrigerators for people. I'm like, what the fuck are we doing? You know what I mean? Like, first off, what the fuck qualifies her to be handling more than $5, let alone $5 billion? Second of all, like, has anybody audited the journal entries of that specific entity? Of course not. So, there's just so much grift and fraud and corruption and abuse and excess cash out there. Like, to the layperson, look at the PPP program. We sprayed like $3 trillion out there. And to this day, they're still finding people that, $500,000, $1 million, abuses, one after the other after the other.
I think it's estimated that nearly half of that went to fraud, and a lot of it even just left the country and ended up like in India.
Of course. And so, like, if we actually had some accountability and we screwed our head on straight and we really did meticulously audit where this money was going, I do think we would have a chance of reining in spending. And I think if politicians in general on both sides of the aisle had a little bit more of a backbone and, just told the American people, like, look, like, we have to move the retirement age, or we have to do, who did that actually? Chris Christie did that when he was governor of New Jersey. He was trying to balance New Jersey's budget, and at one point had to tell like some fucking teachers union of angry, middle-aged, liberal women who were screaming at him at a town hall that like they were being downgraded from like the world's best fucking health insurance plan to the world's second best health insurance plan, and that their benefits were not going to go up by 5%. They were going to go up by 3% in the next 2 years in an effort to balance New Jersey's budget, which I think he did a decent job of. So people don't like to give out news like that because most people are cowards and most people don't have a backbone and most people don't have the nuance and the articulation to explain to people why difficult decisions have to be made. They don't have the patience to do it, or they don't understand it. And so you wind up with a sprawling excess of government wherein ultimately you wind up with Rashida Tlaib managing $5 billion to subsidize refrigerators for low-income people or some bullshit. And that's just going to get worse. For the longer that we continue down this path, the government will get bigger and bigger, and the fraud and waste and abuse will get larger and larger. And these programs, I mean, look at what's happening in New York. I mean, they just straight up voted a communist in. I mean, like, state-owned grocery stores, like, seize the means of production, he said. Like, we're not even fucking hiding it. So as long as we continue down that path and until we make some real serious marked changes. I mean, you see what happened to like guys like Thomas Massey and Rand Paul when they stand up and try to make some economic sense out of things. They just get fucking steamrolled by the right and by the left. And so, I guess if there's something to be hopeful about, it's one that, as Lynn Alden would say, nothing stops this train, and we kind of at least understand the direction things are heading. So maybe we can prepare for it as investors and people that manage our own money. And two, like, maybe we do have a chance of like kind of growing our way out of the problem, but who knows, man? Unprecedented fiscal and economic situation that has never before happened throughout the course of history in the way that it's going in now. And it's going to result in an unprecedented result, the likes of which we can't predict. We don't know when it's going to happen, and almost assuredly is going to be very uncomfortable when it happens.
All right. So, I mean, a lot there, but I would say to me, the biggest disappointment was that a couple of years ago, if you were an Austrian and you were talking about how the government's stealing your money through inflation, the general public did not want to hear it. They didn't care. It was some esoteric concept. Right. It was not on their radar. All of a sudden, probably because of the shutdowns over COVID and government spending and sending people direct checks, people actually saw it at the grocery store. They were experiencing inflation. It became an election topic, and people were aware of, oh, I'm losing money because it's being devalued, and inflation became a real thing to the voting public.
Right.
Also, the Doge storyline it had people hooked. Oh my God, look at the waste and abuse of government and look at all of this funding that's going to things that aren't in my interest. Why is there so much fraud and abuse? So the fact that the actual voting public had an interest in let's solve this inflation problem and let's get rid of the fraud and abuse, and then the conservatives just turn around and you've got people like Josh Hawley talking about how we can't cut Medicaid and going for the biggest spending bill ever. It just feels like we actually missed an opportunity here to maybe correct and change course. So on that basis of just kind of understanding where the voting public is at, I feel like this was a missed opportunity.
Well, I feel like you're onto something, and I actually think that one of the things that I've given Bitcoin a lot of credit for is informing people about monetary policy, which people have been informed about monetary policy in a couple of different ways. One is by watching inflation absolutely torch their purchasing power in a way that it hasn't over the last 20 years, because inflation has been a mystery. And how do we get more inflation? And what is inflation? The central banks, we don't know. Buildings full of people using Excel Professional Edition and spreadsheets and PhDs, and nobody knows what inflation is. It's like some tropical insect that exists in some rainforest somewhere that we can't identify, and we don't know what it eats, and we don't know where it came from. And it's so fucking ridiculous. But when people go to the store and they realize they're getting half as much cereal in a box for twice the price, and they have a budget that they're using to shop every week, it becomes very clear to them that something is fucking wrong. And so immediately they're prompted to try to understand, why am I getting less for more money? And that kind of begs the question of, okay, how do I, the average person is kind of learning about this dark inflationary machinery that happens in the cloak of night and in the background, that has kind of been whirring along, that nobody really talks about for the most part. Nobody really understands it well, yet it has kind of enabled this central banking Ponzi scheme for the last couple of decades. But now people are being forced to learn about it and to address it, because they want ways to opt out of it, essentially, and figure out how to preserve their purchasing power. And so Bitcoin gets a lot of credit because, even though it's not my first choice as an inflation hedge, and really gold and silver, I would say I would put above Bitcoin, though I do own some Bitcoin. But Bitcoin gets a lot of credit because you can't understand Bitcoin without understanding monetary policy. So when you're trying to explain to the average Joe about what makes Bitcoin's whatever limited supply appealing, or it always turns into a conversation about what is sound money. It always turns into a conversation about fiat. It always turns into a conversation about monetary policy. And so then all of a sudden you have this younger generation of 20-year-old, late teens, early 20s, just absolute cypherpunk mixed with fucking just crazy college kids, tattooed freaks, just young kids that are mainlining monetary policy because it's a shoehorn to understanding Bitcoin. And so Bitcoin gets a lot of credit for that. And that is that's something that makes me very optimistic, because I know for sure when I started my podcast in 2017, around then, sometime around then, I did so because the people that I enjoyed listening to, like Peter Schiff or Bill Fleckenstein, weren't being invited on cable news anymore. So I said, okay, I'm going to make an excuse to interview these guys because I want to hear what they have to say. Back then, no one was talking about. I mean, other than these guys, other than the Austrians, nobody was really talking about monetary policy in a household, or an average run of the mill person. It was just kind of stuff that was a little bit obscure. It was kept to the cable news networks, talked about mostly whenever there was a catastrophe or a crisis or something broke in the currency markets, or there was an impetus to talk about it. But now it's kind of like you're saying, it's the parlance of our times. It's, once inflation became a political football for the election, all of a sudden it became as mainstream as the Super Bowl, as mainstream as fucking keeping up with the Kardashians. And that empowers people to understand it better. And that makes me a little optimistic that, at least we're wrapping our head around the problem more so now than we ever have. But who knows if it's too late?
Yeah, that is interesting because anyone buying Bitcoin, especially if you're a younger kid, the core pitch is essentially you can opt out from government fiat currency, which will endlessly print and steal your wealth, which means you have an awareness of the concept of inflation. All right, I got one more question for you on this new bill that was just the new spending bill, and then I want to move on to the bond markets, which is what I really wanted to pick your brain about. But obviously, Trump's general pitch here is, hey, listen, don't worry about the deficits. I'm lowering taxes, so you're going to see growth like you've never seen. We're also going to raise all this revenue because of the tariffs, which I'm going to put on, off, on again, and we'll see where they even land. But how do you contend with, I guess, Donald Trump's claim, or at least what the seemingly his claim and pitch for this is hey, don't worry about these deficits, we're going to have great growth and we're going to raise money through tariffs?
I don't really contend with it. I mean, we'll see what happens. I actually trust that Scott Bessent is very smart. I listen to him speak. I think he knows what needs to be done. I think he knows that debt needs to be rolled over. I think he understands how out of whack the country's fiscal house is. And I kind of do trust that they have some type of scheme cooked up behind the scenes to really catalyze that growth and to try and, temper debt to GDP by doing that. I don't know the specifics. I don't think Trump is just saying that just to say it. I think he's serious about it. I think he is already, he's bringing in more revenue from the tariffs now, and some of the tariffs that'll remain permanent. I do think that the tax cuts are going to be a good tailwind for the country in general. I think that, I don't know where corporate taxes or personal taxes are in relation to the Laffer curve at this point, but I can assure you that it sure feels like everything is overtaxed everywhere. And so just going on instinct alone, I feel like tax cuts are going to help create a more vibrant economy and, free up more capital to allocate for things like investments and things like domestic growth. So, it's kind of a wait and see situation. I'm not the congressional budgeting office. I don't know the budget well enough to opine on, exactly whether or not I think it'll work or not. But for me, I kind of have stopped trying to do that over the last year or two. Like I said to you, I stopped doing my podcast for the most part because a lot of it really is wait and see for me. It's an unprecedented experiment, and I just don't know. I don't know which direction things are going to go, and we've lost our compass so badly that anybody that's tried to trade macroeconomic data for the last 5 or 10 years knows that there is no compass. Nothing makes sense anymore. Up is down, down is up. Bad news is good news some days good news is bad news, some days good news is good news, some days, it's like, just look at Friday, with the jobs number that comes in, you think all right, well, this is guaranteeing that rates are going to stay higher for a little bit longer. You think that would have been a negative for equities, but equities rallied after the job number comes out. And it's all right, well, which fucking direction are we facing today? Are we buying stocks because the job market looks good? Are we selling stocks because it's going to keep rates high and that will, contract the economy? Are we in multiple expansion? Are we in multiple contraction? With the Schiller PE at 35, are we staying here? Is this the new normal? Are things going to revert back to the mean? And is the market going to crater 70%? We have distorted things so badly over the last couple of decades with the money printing and with the quantitative easing. Nothing makes any semblance of sense anymore, other than most people know that the Fed and the Treasury are going to do whatever they can to create the appearance of, nominal stability, meaning, i.e., they're not going to, let markets crash without a fight, and they will zone in on whatever part of the economy starts to fall apart, like they did with the regional banking crisis, where they say, okay, the Fed's going to buy your treasuries at par, even though they're not at par. Like they're going to do whatever they can to just paper over and give the appearance of, and that all just goes back to inflating the money supply, which results in loss of purchasing power of the dollar. Rick Rule just did a great podcast somewhere. I was just listening to him where he laid out all the reasons why he thinks, the purchasing power of the dollar is going to decline by 70% over the next like 2 or 3 years or something ridiculous like that. And when you think about it, that is the only direction we're heading, because the other direction, instead of like a soft default, is a hard default. And to go back to the spending bill, we don't have the balls to fucking say to anybody, I can't pay it, or we don't have it, or whatever. The line is, and you see it this week, Bissett said it this week, a couple other people, the U.S. will never default. And it's like, bitch, we've defaulted already. It's just a soft inflationary default. Like what he's saying is like, we're not going to turn to, somebody and say, we can't pay your bill. It's like, no, we're just going to fucking monetize it.
All right, so let's look at the tools that the Fed has left. I think you were referencing with SFB. That was the bank that failed. And I don't really remember.
That has plenty of tools.
One of the tricks that it pulled was that you no longer, I think, had to mark your bonds to market so that you could hold them. Yeah, so that you didn't have any of those losses. It was something along those lines. I don't remember the particulars. But I guess this was the piece that you wrote, which was the canary in the bond coal mine, which is, can the U.S. continue to fund this level of spending? Is there enough interest in lending money to the United States government that as Donald Trump is looking to replace Powell or do everything he can to push down interest rates, which, as much as I don't think the Fed should exist and there should be a free market for interest rates, I also understand if you're the government and you're looking to spend as much money as possible, why would you spend more money to finance that debt than you can? And so the government itself has an incentive just for its own spending to push down the price that it's going to have to pay. And so just to kind of set you up here, you were writing a piece where your outlook is that the market does not want to fund basically our debt at, even 4% or 5%, and it's starting to push it up off of the 30-year treasuries. So I'll hand it back to you to kind of give us the picture of what the actual market demand is for the debt.
It's not even that specific. The piece, generally, the point of the piece was just watch the bond market. And that was all I was trying to say. I'm like, the bond market is going to tell you the answer to the question you just asked me, which is like, hey, do you think they're going to be able to grow their way out of this problem? And it's like, I don't know. Like, watch the 10-year. The bond market's going to send a very clear signal as to whether or not the government, real sharp investors, sophisticated investors, foreign investors, the people that deal in the treasury market, whether or not they believe that the government remains creditworthy and has a shot of, rebalancing its checkbook, essentially. So the whole point of the piece was, don't really pay too much attention to stocks in the way that you would pay attention to bonds, because there's something obviously out of whack with the bond market where the federal funds rate, goes down 100 bips and the 10-year yield goes up 100 bips, which is just, it's a strange dynamic in the bond market. And then, of course, during Liberation Day, when Trump implemented all those tariffs, the 10-year yield started to skyrocket again at a time where, really traditionally, you would think that the bond market would be the safe haven, right? Because the equity market was losing 3 or 4% a day. And so traditionally what's always happened in those type of situations is, the risk off play is to take the capital that you have in risk on equities and move some of it to the bond market for safety. When really the stock market and the bond market were selling off at the same time, which is something that, you see in like emerging markets. And so what does it mean for us? I don't know, because we're the global reserve currency. And there really doesn't seem to be anything like teed up at the moment to replace us as the global reserve currency. And you also don't know who is buying these treasury bonds. So when there's an auction, a lot of this, I have friends that say like, a lot of the demand comes from like these offshore entities in the Cayman Islands and We don't really know like who is putting the bid under the bond market in some of these auctions. And I wouldn't put it past the Fed or anybody, the Treasury, whatever, to be doing some type of end around where they're creating the appearance of a bid for bonds where there isn't one. Because just like you said, talking about the BTFP and in the regional banking crisis, this idea of like, okay, mark the bonds at whatever the fuck you want. This like accounting trick, like everyone's saying, like, oh, maybe they'll revalue the gold on the Treasury's books to $3,000 an ounce. It doesn't make a difference. I mean, we still have the same gold. It's you're moving numbers around on an accounting ledger. You're not tangibly creating any value anywhere, and that's the same thing. Like, how many private credit companies right now have absolute dog shit on their books that they haven't marked appropriately? Like, if like these Harvard endowments and Apollo and all these private credit companies, if they had to go out and find a bid for the fucking private paper that they had on their balance sheet, they would be hitting the bid at 30, 40, 50% lower than whatever they have this shit marked at in their books. So does the fact that they have it marked up in their books change its value? No, because when you need to find a real world buyer, you're not going to be able to meet that price. And so that's the attitude that the Fed has, which is just cover it up, figure out a way to make it look nice, eventually monetize it. Hopefully you can stabilize things. It all comes out in the M2 wash eventually at some point. We're all going to bear the brunt of it, with inflation. Hopefully it's not too onerous. Hopefully with hedonic adjustments and gaming the CPI, we can make it look better than it really is. I mean, look, there's no way prices have been going up 3%, 4% a year. You look at something like the Chapwood Index or people that measure these baskets of inflation with real world items, in an objective fashion, prices go up 8 to 12% a year. And it's been like that for a long time. But they're going to tell you the story that that's not what's, I mean, think about this. Think about the idea that the Fed wants you to believe that since like 2021, prices are up 3% a year or 4% a year, which is just crazy. Shit has like doubled in price, if not more. And you see it in the everyday items that you buy. Like, I literally just before I bought this like protein shake, this was like $14, which I was just like, it's crazy. Like, expected, but like still like that's a lot, because like 5 years ago to say like this stupid thing was $7 still would have been a lot. Like, damn, I'm paying $7 for that, like 14 fucking dollars. Like, wow, so that's where it all comes out. It all comes out in the inflationary wash and in this long-standing hope that the everyday American won't take the time to learn the intricacies of monetary policy because they're too busy actually providing the products or services that we use and need and want and doing the work that like Americans benefit from. And they don't have like, my dad was a mailman. Okay. Like, he got up at 6 a.m. He came home at 4 o'clock in the afternoon. He delivered on foot to 260 houses a day. And he did that for 40 years. He raised a kid. He's a great husband. He is a great father. We went to church on some Sundays. Life was good. We always had a car in the driveway, and he cooked dinner at night. When the fuck is he going to have time to learn about how the fuck inflation works? Like, they just don't. Like, average everyday Americans don't have the time to do that. So the Fed is going to count on the fact that and pray that enough people don't learn it and don't understand what exactly is going on. And they're going to paper everything over and try to give the appearance of things looking great. And the absolute bitch of it all, the most fucked up thing about it, is that every time they print, the inequality gap widens even further. And the really fucked up thing is these stupid ass Democrats. And look, there's total dumbasses on both sides of the political aisle. So this isn't just a stab at Democrats, but the Democrats who fucking beg and plead and cry and, advocate for equity, which is, equality of outcome, not just equality of opportunity, and then go and advocate for all of this money printing and, modern monetary theory. It's like That's what's causing the problem. Like if you look at like the net wealth of the top, 90% versus the bottom like 50% of Americans, we're on an accelerating parabolic trajectory. The delta is widening faster and faster, and it's because of the policies they advocate for. And monetary policies like this third rail that nobody will, no, not the Republicans, not the Democrats, nobody dares suggest that this could be what's causing the problem. And so at some point, we will hit a terminus where either enough people understand it, so we have quorum in the United States population, enough so that people, make enough noise about it, or somebody in the political spectrum is going to have the balls to say, like, this inequality problem we're creating under the guise of, whatever, universal basic income, trying to make everything equal. They're just making everything worse. So, socializing quality of life for people and socializing bailouts and losses and all these accounting errors, all they do is make things worse. And then people come back and look at this guy, like a guy like fucking Zohan Mamdani in New York, who's essentially promising communism. It's like he's reading from the book. It's like he's reading from like the communist handbook. And he is, what does he say in Die Hard? Like, the FBI has the International Terrorist Handbook and they're running it step by step. Like, this guy has like Karl Marx, how to fucking do it, 101. And he's just running it step by step. And in another article I wrote last week called There's a Lot of Honest Pain Out There, it's because there is a lot of honest pain out there. And this guy's ideas do seem like they make sense when you're hurting a lot. But what people don't realize is that his policies are only going to make things worse, which is going to make people blame capitalism more so than they're doing. And then all of a sudden, you have a big, ugly downward spiral into a fucking communist mess. And that sucks. So who is going to fucking have the balls to talk about the money printing and how it widens the inequality gap on both sides of the aisle? That's the question.
All right, so I got two more questions for you, and this one maybe it'll be too loose for an answer, but it sounds like you're basically very long on the Fed put, and that they will do everything they can to not allow asset prices to come down, and that we will not be looking at deflation or any of these bubbles popping. So I guess I'm curious, where do you think are going to be, like, what are going to be the first things to crack, and what do you think are the tools that the Fed's going to throw at it to kind of mask it over?
Well, I do think we'll have like a sharp deflationary moment, and then the Fed put will come in and everything will be. So I am long on that. It's the only way. It's all roads lead to that direction. We don't have the balls to default. So again, to quote my friend Lynn Alden, nothing stops this train, right? That's the direction we're heading. What was the second part of your question? You asked.
Well, what are the tools that you think? What do you think's going to crack first, and what do you think are the tools they're going to throw at it?
You know what? It could be something that we have an idea about. It could be, like I said, it could be private credit. It could be commercial real estate. It could be, treasuries on bank balance sheets. It could be. Look, there are innumerable ways that we could have some type of catastrophe. I mean, if bond yields continue to rise, that would be a nightmare. If the dollar plunges, if the dollar gets too strong, I mean, there's tripwires in like every direction. It's like we're in one of those rooms that's like full of rakes on the ground, and everywhere that we step, one just comes up and hits us in the face. Like, it could really be anything, or it could be something completely innocuous, unexpected, like full on black swan, the type of situation where some guy notices an error on a receipt at a Dunkin' Donuts in Belgium, and he fucking goes to complain to the manager about it, and it reveals 20 years of accounting fraud at Dunkin' Donuts corporate, which in turn kills their counterparties, which in turn brings down the cocoa market. You know what I mean? Like, The funny thing is that like when something breaks, whatever it's going to be, I don't even want to guess. But like the obvious like front runners to me would probably be like commercial real estate, the housing market, like the auto market is a fucking nightmare right now. Like used autos is a nightmare. There's a lot of dog shit paper floating around. Companies like Carvana and CarMax, and there's a lot of ugly bank paper. You have these banks that are lending to people that big banks won't lend to. I'm not going to mention names, but a lot of the regional banks. Go look at any banks that pay like a suspiciously high dividend, and have like suspiciously good like price to book, price to earnings ratios. A lot of that usually is just marks that aren't necessarily legitimate on paper, or deferring debt they call like extend and pretend, those types of things. So it could be something like that. It could just be like a straight up economic contraction. One thing is for sure, with the cost of debt at 4% still, with interest rate, or the cost of capital interest rates at 4% still, or 3.5% even, there's no doubt that there is a economic contraction working its way through the United States economy, and there's no doubt that it will eventually turn up in the job market. It's just a question of how long we can extend and pretend, and how much extra liquidity from the COVID, fire hose of liquidity is still out there that people are still clinging to. But it's getting kind of ugly. If you look at credit card delinquencies, you look at auto delinquencies, you start looking at like, eventually it turns up in mortgages down the line. But you start looking at those things, it could be anywhere. Private credit, I think, is an area that's like talked about a little bit, but maybe should be talked about a little bit more. We'll know when people try to move paper in private credit and they can't. It's like look at Silicon Valley Bank. That was like a Friday. They came out and said that they needed to raise capital all of a sudden, and they got hit with like $50 billion in redemptions in 48 hours, right? So like, what was it? It was just them surprising the market on a Friday saying, hey, we're just raising $1 billion just for no reason at all. And people are like, oh, fuck, like something is completely fucked behind the scenes. So it is a bit of hyperbole to say, like, to use the analog of a guy finding an error on his receipt in Belgium at a Dunkin' Donuts that leads to finding 20 years of accounting fraud. But like, look at Luckin Coffee. Like it could be something like that. And to try to guess is, I've just made a fool out of myself trying to guess over and over the years. It's difficult on timing and it's difficult to pinpoint, but for sure, something out there is already fucked and there's a cover up in place. And that's how things work. Like, we don't learn about it, not when the CFO discovers that there's accounting fraud. Maybe that has already happened 2 years ago. And either they're in the middle of a cover up or they're in the middle of trying to rectify it. But at some point, someday, you have to put that fucking 8K out that we're raising capital. Or you have to put that, the auditor says enough's enough. Like, we're issuing a qualified opinion, or we're writing a letter saying, we need more time for the audit. At some point, you bump up against a wall where you can't go any further. And then what you have to remember is that, like, so many people have exhausted so many of these extend and pretend options at that point. They've done all the accounting shuffling. They've lied on the conference calls. They've made the off-balance sheet arrangements. They've secured emergency capital. They've tried to spin off their garbage. It's only when there's literally no choice left. And then that cascades really quickly. So I'm sorry to not be able to give you a specific answer other than, again, private credit, commercial real estate, bad auto loans, subprime banks, regional banks, all are worth watching. But there's companies out there insolvent, like completely insolvent balance sheets right now. We just don't know about it yet. There's cash. I was talking about this yesterday. I'm not going to name the company in particular, but I know that I just have this feeling that there's cash on balance sheets out there that really isn't in bank accounts. And by the way, if you're ever looking for that, a good way to check is to look at a company's interest expense or interest earnings. What, if a company says they have 10 billion in cash and, rates are at 5%, you want to make sure that annually their interest that they're gaining from their bank balances is at least what the federal funds rate is. If it's significantly lower than that, that's usually a sign that the cash,
Doesn't
something's
exist.
fucky.
Yeah.
Right.
All right, so I'll hit you with one last question, and we'll take a second for plugs. Everyone can follow your Substack, Quoth the Raven, where you're not allowed to give picks. You don't give picks. You're pretty transparent that you get things wrong, but thus far, I think you're having a pretty good year above the S&P. But I'll let you if you want to add to that plug at all.
I don't, other than saying, I get a lot of things wrong. I try to do my best to talk about things that I find interesting. Usually what I've been doing the last couple of years is at the beginning of the year, I, name a couple of themes or ideas or things that interest me to watch for the year ahead. Last year those themes kind of underperformed the S&P. This year they're outperforming the S&P. I don't like getting praised when I get things right, and I don't like hearing bullshit when I get things wrong. And so really my motto is do your own research. I don't give out financial advice. I'm just kind of writing to write, and trust no one, including me and
There
including
you
you.
go. All
You
right.
know,
Well, definitely don't trust me. And aside from this, I got my own personal podcast, Run Your Mouth. I also do a podcast with Dave Smith, Part of the Problem. And I'm out on tour. I do stand up comedy. Porches all nationwide. You can find them at porchtour.com. And this Sunday, I am headlining at the Secret Group in Houston, Texas. You can find that link on their website. All right. Last question I got for you.
and whatever you do, don't look for me this Sunday. I will be in an undisclosed location hanging out by myself. So
That rules.
if you're looking to socialize, go to your show and fucking leave me alone.
There you go. That sounds like a nice 4th of July right there. All right. I am not, not that I'm a very high income individual, but I'm pretty good at being frugal and saving my money. And I work basically 3 jobs and long days. And the last thing I like doing is actually researching investments. So for the most part, I would say most of my savings is just in high yield savings account as I keep thinking the stock market's going to collapse and I'll shift over. That never happens. I have, I put some into gold, silver, Bitcoin to because I do favor those assets, but I'm pretty risk adverse. I was reading some of your stuff, and I guess the other thing that should be, I guess, in the basket of stuff that might just continue to rise as the Fed endlessly prints money and does the put is real estate. I currently don't have an interest in purchasing a house. I'm curious, what is like the easy real estate play if you were trying to just add some of that to a diversified portfolio, or what are some of your other kind of picks for, what you think are just more stable and a little smarter than just holding cash?
I don't really give like financial advice, but I'll tell you what I would do. I mean, other than like, owning a little bit of real estate, which, you hope, like I said, I do think we'll have this deflationary incident. So I do think that there will be a buying opportunity for real estate at a cheaper price than it's at now. I do think that's going to happen because these things kind of trickle through. When the economy contracts, first it's discretionary spending that slows down, and then all of a sudden it's like, oops, I missed one credit card payment, and then all of a sudden it's like, oops, I missed a fucking car payment, and then very later down the road that turns into mortgage payments. And but it takes a very long time. There's a long lag for that to play out. Having said that, we're 2.5 years now into higher rates where policy is restrictive, and I do think that it's wearing its way through the economy, and I do think eventually we'll have this deflationary event, and I do think it will hit the housing market at some point. I don't know if it looks like a 10% pullback in housing, or if it looks like 2008. I really don't know. I don't think we'll have a 2008 again, but I do think there will be an opportunity. And I think, for me personally, the way that I have my exposure to real estate is I just own, a little bit. I own my very tiny studio apartment, which is great because as as everything inflates nominally, that catches a little bit of that tailwind. And also, it's great to live there. I don't have any intention of selling it, so it provides a purpose in that sense. But I think something like if you just want plain vanilla exposure to real estate, one of the things that I own is the VNQ, which is the Vanguard REIT fund. It's like super low fee. And I have it set up in one account where I buy it basically on a recurring basis. So I'm nibbling a little bit of that, every week. It's like your standard basic vanilla ETF for like REITs. Um, will be I don't think has been like outperforming. I'd have to look at it in any way because I think you have this commercial real estate issue where a lot of commercial real estate is shifting to multifamily, and you kind of do have these like crosswinds in the real estate market right now a little bit, and there is a bit more selling than buying, I think, now than there has been over the last few years. But I think if you just wanted something to add to occasionally to just get that little bit of exposure and then the little bit of income that comes with it, personally, what I would do is if I did see whatever 20% pullback in the real estate market or 10% pullback in the real estate market, I would personally be inclined to, raise the allocation to an ETF like the VNQ just to, continue to buy it a little bit more aggressively as it comes down in price. But essentially now, as with all equities, you're essentially buying the top here. So I'm just throwing a little bit at it little by little. But again, that's what works for me. I'm not a real estate expert. I personally would avoid. I would I would avoid any regional banks that have a lot of exposure to commercial real estate paper. And there's ways that you can find these online. There's lists of regional banks and the percentage of what their loan book is tied to commercial real estate. I think that eventually a lot of that paper is going to be defaulted on. And I think a lot of it's probably already gotten kind of ugly. So for me, it's just, slow and steady kind of diversification into that Vanguard ETF. They charge like 5 basis points a year or something ridiculous, and then just owning a little bit. But aside from that, I like gold. I like silver. I think gold miners have good highway to kind of run ahead of them. Adrian Day, who is Peter Schiff's gold and silver portfolio manager, just did a great interview on Palisades Gold Radio. So if you're looking for insight as to the leverage that miners get versus the spot underlying and why we could still be in the early innings, like to me, I found that to be a great listen. Adrian Day knows his shit. So gold, silver, palladium, copper, rare earths, the REMX. I have some exposure to that. Anything that's fucking like anything that's relatively finite in value or isn't like immediately printable or like able to be manipulated, I think nominally goes higher, whether it's equities, whether it's real estate. So I'm just kind of spread out as much as I can be. And emerging markets too is the other thing that I like. How I do have some select plays in emerging markets, but personally, like I prefer to own the EEM, which I think is the Vanguard emerging markets. Nothing to think about. It's a basket of all these other emerging markets. For a couple of reasons. One, I do think that there is a recalibration on the global stage as to how much of a power player the U.S. is going to be, and I think the more the U.S. kind of slips out of that role, the more that these emerging markets, Vietnam, Thailand, Colombia, fucking you name it, Argentina, Greece, like all these, they will kind of come up to rise and kind of meet the U.S. as it falls a little bit. So I think our market with its PE of 35, and you look at something like, I don't know. I know this isn't right, but I'm just going to throw it out there. Something like, Korea or something, or like fucking Vietnam or Brazil or, any of these other countries that have PEs that are, closer to 10 and 15. I think there will be some reversion there. So I buy the EEM the same way I buy the VNQ, which is just on a steady kind of recurring basis. Spits out a little bit of a dividend. And then if you see stuff that you like in individual countries that's appealing, you can go in and invest accordingly in their specific ETF or with companies that you like. But gold, silver, Bitcoin, real estate, emerging markets, and select US equities, which is like I don't own a lot of pre-revenue bullshit. Hey, thumbs up. I don't own I don't own really aggressively valued stuff. I don't own things with, price to sales of 40 or 50 or price to earnings of, 60 or 70. I do have some growth, but for the most part, I'm looking for, value. There's not a lot of it out there. A lot of it's in miners, I think, still. But occasionally,
Lem-
like, for example, like a name like Google, I think there's value in Google comparative to the rest of the Mag 7. It's trading at like 20 times earnings, which is relatively modest. It's got a call option on autonomous driving. It's got, there's some worries about the search engine capability being taking losses as a result of ChatGPT, and there's antitrust issues, but I think they will survive. They're diversified, so a name like that, to me, that looks like close to value at this point. What were you going to say? Sorry.
All right, yeah. So I do have one more question for you. You were talking about the gold miners, and I remember like 5 or 6 years ago. Sometimes I go with the investment advice of the last person I spoke to at a bar, which is not great. And I'd wanted to just be putting. I think in my head it was like between 3 and 5%. I just wanted to be buying physical gold, and someone just convinced me,
Yeah.
forget physical gold. You need to buy the gold miners. It's easier, and there's more growth there. Blah blah blah. And I was like, all right, this makes sense. And he was in the gold space, and I must have bought the Sprout Junior and the other one, which are kind of like ETFs, I think, in the gold space. And anyways, my experience, at least at the moment with the gold miners, is that as gold has gone up fantastically well from when I bought those, these things have not moved or might even be a little bit down. Why is there such, at least at the moment, such a discrepancy between kind of the increase in gold price over the last 5 years, while at least the gold mining stocks that I own seem to just be
Yeah.
flat?
Well, I think that first off, they're not completely flat. Like they've done really well over the last like year or two, but they haven't kept pace with the price of the underlying. So essentially, like miners are supposed to be a leveraged bet on gold for the most part. You're buying the gold that's in the ground still, and as the price of the underlying increases and some of the costs of mining stay fixed, you're essentially hoping that you get some hockey stick leverage as the gold price, as they can sell the gold for more and more, and some of the costs remain relatively fixed, or in some cases are even falling. In the case of like oil, which is a huge input cost for gold mining. So what I think is happening is I think that miners have had such a bad track record over the last 20 years that they're still kind of climbing a wall of worry. You look at these names, like you look at a Barrick or a Newmont or a Pan American Silver or an Agnico Eagle, and like, just throw a dart, man. And you're talking about companies that are trading at like record low, like price to cash flows, like, 10 times earnings. They're spitting out dividends. Like, and that wall of worry can only last for so long. I think that a lot of people, to the best of my understanding, a lot of people still had modeled the price of gold, the underlying, lower than it is. So I think a lot of models for 25 and 26 still have gold like, in their models at 2,000 or $2,500 an ounce. And so I think when the market sees that the price of gold probably not going to go under 3,000 again, at least anytime soon. And that really we're here to stay. And if you listen to somebody like Rick Rule, we could be going double or triple higher over the course of 5 years or something like that. It's going to be very hard to ignore the miners the way that the market has ignored them now. At some point, people like myself that just look for value anywhere in the market, they're going to be forced to see that there's value in the miners because they're just spitting off so much cash. And with the price of oil again starting to come down, and input costs remaining relatively, I mean, these companies have had great quarters over the last quarter, and I think they're just going to get better as the year goes on. So, it's like it's proof that there's no efficient market hypothesis, right? That like the market isn't always zoned into the right spot. But I do think what we'll see at some point is miners will become like the trade. Like AI is the trade now. I think we're a long way from that. When that happens and CNBC has to talk about it because they're just fucking blowing the doors off that much, or it has just become obvious that really they have climbed the wall of worry and there's essentially some FOMO in miners. That's when you see the multiple expansion that even at like today's input costs and today's gold costs, these names could be trading at double what they're trading now just based on multiple expansion. It all has to do with the sentiment of the market and whether or not people feel like it's a need to own asset. And right now, I think given gold's miners' reputation in past years and the fact that, like you're saying, they have stagnated for the most part, they're simply on a lag. Gold has exploded higher over the last 3 years, and miners are kind of the cart behind the horse. And eventually the cart will catch up to the horse, and eventually the cart will get in front of the horse. And that's when I'll be looking to take some exposure off. But if you ask me to come up with a scenario in my head of what that looks like, and again, I don't give financial advice. I'm just guessing. I'm like a regular fucking dude, like that just, normal guy, not Mr. Finance guy, just in my fantastic brain. For me, I could see gold go to 4,000, which is maybe a 20% rise from here. And I could see the GDX double from here. Like, to me, that makes sense. That is what that is that's, psychology changing and that cart starting to catch up to the horse a little bit. So I don't think it's out of the question to see the GDX over 100. There were the GDXJ over 100. It's just a question of how far things will overshoot the mark to the upside when they really do get that momentum. So I hope that I'm right. I think that I'm right. In the meantime, happy to look at an income statement and compare it to tech bullshit and say, okay, here's a cash generating company that's paying a 2% yield. They're paying a dividend. They're generating free cash. They're trading at 8 times free cash. They're trading at a 15 PE, and it gives me exposure to gold versus like here's an Nvidia which has got a $4 trillion market cap, trades at 50 times sales and a billion times earnings. And who the fuck knows what's going on with their accounting and their customer concentration and things. So for me, it's just much safer, much more conservative, and way easier for me to own miners and be very secure. The biggest position I have is the GDX. So like if you're talking about like my portfolio, like in just equities, like my biggest equity position is the GDX. Probably second, third, and fourth are probably like the SIL, PAAS, which is Pan American Silver. What else do I own? I own the GDXJ, the SILJ, which is the junior silver miners. So, I mean, if you put those all together, you're talking probably 15% of my portfolio, I would guess.
Funny, I actually own all of these. Look at me, I'm not doing that bad. I got a buddy who's in the mining space who has a similar feeling to you that all this tech hype is going to go away and basically get obsessed with the physical assets and the mines. All right, thank you so much. This was a great episode, and really glad that you came on and gave us all the insights, and hope to do it again down the road.
Yeah, thanks, man. It's cool that you're doing these for Zero Hedge. Love the site and really appreciate the invite.